We are up and running. Welcome, Pat. Welcome to our millions and millions of viewers.
Yep. How you doing, folks?
The hour every Friday where we try to break the internet. And so far we haven't. So just my microphone here a second. So not a lot changed, but there are some July numbers that are rolling out, and as expected, July's on fire. The June numbers are really good. The July numbers coming in. We actually set a record in Arizona at $4 billion in sales, the highest monthly sales volume ever in the history of real estate in Arizona. So that's pretty big. This can do a couple things. It may shake the tree and get people to finally start putting their house on the market, because this week we also went below 8,000 units for the first time. We went down to 78, I think is where we came out. Now today we're at 8296. So as we look through the week, Monday it goes down, and then Tuesday, everything that goes under contract from the weekend shows up as under contract by Monday afternoon. So when I check the numbers Tuesday morning, that's when I see the lowest number of homes available for the rest of the week. Then they start popping up on Thursday. Then today we hit the highest number. So today's the peak of 8296, and it'll go down from there. 35% of listings are sold on Saturday and Sunday for the week. So outside of that, we had 4,339 homes hit the market this week, and 4,115 were sold. And for the second week in a row, we sold less than what came on by 200 units, where each week prior to this, I was seeing that we were selling more than what came on. We'd have 4,000 and we'd sell 4,400. So that's a subtle little change, but it's not a big game changer, but it's just an interesting number to look at. The inventory it's not going up, that's for sure. I mean, we're not seeing anything that shows it getting any higher, and there isn't any indication yet that that's about to happen. I was on a call with the Cromford report that looks at all this data, and they're showing the Cromford index, which is a mathematical calculation that compares supply and demand, and it tells the future of where prices are headed 3 to 6 months out. And so historically it does that, and they have this measure. So if they have a number of the Cromford market index of 100, it means the market's balanced, okay? It's buyers and sellers, it's going along pretty even. Prices are staying stable. If it goes to 200, then it's in favor of sellers, and we can expect prices to increase in the next 3 to 6 months. Okay? So that Cromford index, where normal is 100, we have cities now, including Chandler, the index is 435.
You gotta be kidding me.
It's not just up a little. You look at the number and go, are you kidding me? I mean, it's not just a seller's market. I can't even describe it.
No.
So, but one of the things she touched on, she goes, now look, to see a crash, we've got to get inventory numbers up to what we were seeing in 2006. And when you look at that chart, there's no comparison. We had almost a year's supply of homes. Right now, our active supply of active homes on the market is 2 weeks or less.
What was the supply back? It was like 07, 08. I mean, there was like 45 and 50,000 homes, I believe, in that range. To give people a perspective of what, because going back in 07, 08, if I'm not mistaken, there was supply of anywhere from 40 to 50,000 homes.
Correct.
Available.
Yeah. And then the buyer traffic started going down, down, and down.
Yeah. Now it gives people perspective. So we're at 8,000 right now.
Yeah. Yeah. So those of you sitting out there waiting for a crash, it's It's not happening this year. Now, we could have something for the economy just really come in and hit us hard. The numbers we're seeing are bad. It's not a good story to tell. I don't see it getting better anytime soon, but it's going to have to be a credit problem. It's going to have to be a financing problem and a getting loan problem in order to crash us, a banking crisis per se. There's been a few hiccups out there that are giving, some investors some concerns, but nothing barking at us. So, but that could jolt us into a high inventory, but you'll see the graph change dramatically if that happens. But even CoreLogic, which we were talking about a little bit last week, they predicted a 6.6% decline in prices nationally in 2021, just 30 days ago. Already, after looking at the June numbers, they've revised that to us going down 1% nationally. And it doesn't look like that's going to happen here in Arizona at all. So in order for our prices to go down 1%, we're going to have to flatten out here and go down pretty quickly, because 2021 is right around the corner. So we're going to have to see a spike in inventory. And then I did an interesting, have you heard of Google Trends before?
Mm-hmm. Yep.
Let me share this with you. I looked up foreclosures on Google Trends. People looking the keyword foreclosures. Here's 2008.
Yep.
How many are looking? And here's now. So people aren't even inquiring about foreclosures and haven't been since 2013. There was a lot of activity here, and then nobody cared there. So we're back down at the level of 2004 as far as people, looking for information on foreclosures. So, that may be kind of an obscure, that's probably something that pops up right when you're in the middle of it. But there's no foreclosures out there now to buy at all.
I mean, right now, obviously, forbearances, we talked about forbearances, but like you said, there's $6 trillion with this. Like you said, people that just come out and say there's going to be a crash. I just think that's kind of like saying, it's very, unless you've got some data behind it, like you and I've talked about, it's just a very open, not thought out statement, because there's $6 trillion of equity. People got $6 trillion of equity in their homes. Like, they didn't have that back in 07, 08, and 09. And also they were obviously floating 5 other homes, as I mentioned last couple months. That if they had 5 homes that they own, they're all on interest only, the weird ARM loans, and they had no equity in those homes. So now if you have 4 or 5 homes, you probably have, in each home, if you bought them a couple of years ago, you probably have $50,000 to $150,000 in equity. You're going to protect that. So there's going to have to be a major jolt, I see, economically from my standpoint, because, from a crash, the crash is not going to be, mortgage related with weak loans being written, because, as you know, we dot every I and cross every T now. So those type of loans are, far and few between. So that's not going to start the crash. I don't, and I think, people coming over here from California, the in-migration to Arizona has just been phenomenal. And there was an interesting thing to kind of go on, just to kind of bolt away, a little bit to jump in here, talk about the forbearances. They said the forbearances have actually decreased this week, but it wasn't. It was not necessarily because people were getting out of the plans. It said Black Knight, the data that I'm getting this from. It says the one reason behind the reduced number of forbearances was the fact that was the expiration of these initial plans that they put in March, April, May, June, and then July. I would say May, June, and July. So these are expiring. It said it's estimated that about 500,000 were set to expire at the end of July. It said an initial wave of 2.5 million expirations hit at the end of June. And the report went on to say more than 2/3 of the plans that remain in forbearance have had their plans expanded, most for another 90 days. So it said this will mean another wave of expirations involving about 2.2 million plans arrive in September and October. So, I mean, there's been a decrease, but then also then it said here the current spikes in coronavirus cases around the country and the expiration of the end of July unemployment benefits represent significant uncertainty for homeowners, servicers, and guarantors. So, you don't know. There's still that question mark that you and I have been talking about September and October. And they said that the months ahead, obviously the consumer sentiment, there was a survey done. And obviously, a lot of people have said, I don't know if it's the best time to buy because prices have increased. But, they're saying that the sentiment's all going to be based on the coronavirus, how it's spreading, if it's good, bad, or indifferent. And one last thing I pulled up, I saw something from Zillow today. The CEO said that there is a great reshuffling going on amongst people. People are relocating to homes with more privacy and space, to work from home. And he goes, he feels that we're at the dawn of a great reshuffling in the real estate market. People staying from home, being able to work from home. So, people are fleeing. He said people are fleeing, these accelerated trends are fleeing large, expensive U.S. cities to go to suburbs. And, with interest rates at all-time lows, I mean, the 15-year, is around, mid twos, low to mid twos, and the 30 years, mid to high twos, low threes, 3.125%, 3.25%. People, rates, anything under three, it's amazing. I mean, right now you can get your buying power. People's buying power in the last year has increased about anywhere from $25,000 to $50,000 more with the decrease in interest rates, by about a half. I mean, rates, obviously last year were, even back in August, September were, high threes, fours. Now they're high twos, low threes. That's a point. So you can actually, like I said, you can increase your home purchase by about $25,000 to $50,000 more.
Yeah, and I still believe, and I'm still going to stick to it until I see the numbers that tell me I'm way off base. But I still think that in September, October, we'll see some balancing just simply because of the bad economic data, and people are going to be in some tough positions then. And that balance is not going to cause a crash. It's going to end the frenzy. I've never seen a frenzy last more than 6 months. Yeah. So, and we're in an absolute crazy frenzy. And then talking about the different changes in where people are moving, the type of houses they want. I've got a past client that's working to put his house on the market this month, and it's up in Scottsdale, and he's got 3 bedrooms, and then off of the laundry room in the back on the other side of the house is a room he uses as an office, and it's a nice little room. And he asked me, he said, it doesn't have a closet. Should I convert that to a 4th bedroom? And I said, no, don't. Right now, people are looking for 3 bedrooms plus an office. And your office is like from the kitchen, the laundry room, it's back in a corner. I said, people are either going to use that as an office because more people are working from home, or they're going to turn it into a gym because you can't get into the gym. So I think it's popular to have what you're going to offer. And he never thought of that. I said, don't spend the money. It's not a detriment that it's not a 4-bedroom house. It's actually a plus that it's a 3-bedroom with an office.
Yeah.
And so I think in September and October, when the numbers really start rolling in with the number of layoffs and bankruptcies that you just see every day on the news, it's terrible. It's going to affect inventory in a way where people are going to say, well, we better put our house on the market. We got to do something. We got to move, or we have to, doesn't look like we're getting our job back. We got to get something with a lower payment. There's not going to be as many buyers out there as there is now. So right now, people are they just can't avoid these low interest rates. Like, hey, I'm renting anyway. So there's no predicting this. I'm saying that the only prediction that we can safely make right now is, look, if you think there's going to be a crash, you're going to have to tell me what those numbers look like and what's going to cause it. And there are people, I think, that are actually just hoping for a crash.
Oh yeah. Yeah.
And they tell us realtors, well, you guys always say real estate's going up. I haven't been saying that. I've been saying that it's going to be very dicey. It's going to be tough to watch. And I think now's not a great time to be going out and being one of 15 bids on a house. I think you end up overpaying for the house, waiving your inspection period, and making up the difference between what the house sold for and the appraisal. So I think it's a dangerous time, and you're competing with people coming in California with a ton of cash.
Yeah, that's the problem. I mean, that's why they're waiting. I just had another realtor up in Peoria put a client's house on the market. He was talking to me. He goes, well, we'll be pushing if we can get 390 for the house. He's a couple of weeks ago. He goes, we'll be pushing if we get 390. We'll net out this amount of money because he's looking to buy another house. He finally got the house list or sold for 425.
Yeah. That story is repeating itself all over the valley.
And it's just sad for the first time home buyer. They just got to be patient, and have all their ducks in a row. Now, like I think I said a couple times ago, we had this credit repair lady on a couple months ago, and I will just say again, what I see, I just got a call the other day from a lady and a couple that they said, hey, we're looking to buy in April and May. And, the agent called me and said, hey, I got these clients to refer you, but they're not going to be ready. But I talked to them, but I gave them about 5 or 6 points, what not to pay off. Don't pay off any collection accounts. They said they had some stuff with credit. I said, now's the perfect time. August, got them into the company Continental Repair for $80 a month, got them in for credit repair because they got some stuff on their credit. The next 4 or 5 months, they're doing it the right way. We're looking at buying a house in April, May. Instead of calling me the weekend before of looking at a house, hey, we're going to run our credit. We should be okay. You want to kind of put some stuff in motion, 6 to 8 months ahead of time.
Well, we talked a little bit today too, Pat, about you've got pre-qualification and you've got pre-approval. How difficult is it to get pre-approval before you go out and get a house?
It's actually a little bit more difficult. I mean, pre-approval, it basically is a pre-qual is I talk to the client, their assets. What do you think your credit's like? How long your job, give me your job history. I talk to them for, kind of put some numbers together and say, hey, this is what, you could probably qualify based on what you told me. A pre-approval, basically, I run DU. I get all their tax returns or pay stubs or bank statements. Take a look. I mean, if we had the luxury of where lenders were not busy, you could almost send, a pre-approval basically means I can also run it up the flagpole probably to an underwriter at if there's a question mark on a deal, just to get the yes or no. Say, hey, that looks solid. A solid would be if a lender was not busy, you could actually, before they could do TBDs, pre-quals where you run it to the underwriter and they pre-underwrite it. But now they're so busy they can't do those. You have to have kind of a property. But a pre-qual is kind of just a casual conversation.
Well, the reason I was asking was, does that make it a more solid offer when you're competing? That it's my offer has a pre-qual, but it's a little more stronger than your standard pre-qual and pre-approved up to appraisal, pending the appraisal. So
I get, an experienced LO can talk to a client for 15 or 20 minutes and get kind of a gauge. If they worked at Intel for the last 15 years and they've got money, you can kind of see that they're going to be fine. But there's some people you talk to that, they'll say, well, I've had a few collection accounts and, I've changed jobs 2 or 3 times here and there. You got to dig deeper. But it takes about, a pre-qual takes a little bit of time pulling credit, getting the tax returns. Maybe if they're self-employed, that's going to take a lot more time. But, it definitely does help to have a pre-approval.
Well, I think, one of the things that we know is going to happen this week again is that by Monday, we'll be back down below 8,000 units. And in a couple of weeks, we probably won't even be above 8,000 units going into the weekend. The neighborhood that I track in Ocotillo, I'm looking now, and it has 27 homes, and out of those 27, you got 1, 2, 3, 4, 5, 6. 6 homes are just on a new development on Queen Creek Road. So they really only have 21 existing single-family homes for sale in an area that, as long as I've been tracking it the past few years, has averaged about 75 to 85 homes at any given time. And now we're down to 21. So when you're going out to look, and if you're getting hot sheets delivered to you by your agent, or he's called you and said, hey, this home got up, it's hate to tell you this, but you have to make that decision real quick. What time during that day you're going to look at it? And I talked to an agent this weekend, and she said, or just yesterday, and she said she put a townhome up, and she put in the MLS that they would be reviewing offers on Monday. She had an open house Saturday and Sunday. And she said, we'll be reviewing offers on Monday. Oh, and by the way, and then also put in there that because it was a townhome condo, it didn't qualify for FHA financing. First offer she got was FHA. Some new agent, didn't read it. Second offer she got was from this guy that said, I've been selling real estate for blah, blah, blah years. I've got a 90% close rate where the average agent has 70%. And I'm not going to play in any bidding situation. And you've got till Sunday to approve this offer. And she just said, well, we're not even reviewing them until Monday. He goes, fine. Monday at 10. So she sent them back an offer, or an email, text message at Monday at 10, and said, we have 2 offers. Here's where they're at. And he said, I'm out. And that's not the agent you want in this market. I'm out.
Yeah.
You know, the agent has to say, okay, well, let's take a look at this and see what you've got. Are they waiving appraisals? How strong is their financing? What's it going to take to get my client into this home? Now's not the time to dig your heels in and just arbitrarily say, well, you're reviewing on Monday. That's not going to work for me. I mean, we're seeing some really stupid stuff going on out there. And, and I'm seeing a lot of online inquiries too, for me, saying, what can you tell me about this house? And I said, well, what I can tell you is we should probably go see it today if you want to see it, because there's nothing to talk about tomorrow. It's going to be off the market.
Yeah, the time frame to wait around and chew on it. Like you said, it's definitely a hysterical time. I don't know when it's going to end. I mean, it will end. I don't know what's going to. I wish I had a crystal ball. I don't see anything on my end. You know, just to reiterate, I don't see anything on my end from a mortgage lending standpoint that's going to stop, this, hysteria. The only way I see from an economic standpoint, they did say, the feds did say that they're going to let inflation run over 2%, try to get that kick started. And obviously that's been kind of the benchmark. The Fed's trying to keep it under, it's like right around 1% right now. It's not even there
yet. They're trying to get inflation, but the M2 velocity chart that we shared last week shows that money's not even getting out there in circulation.
Yeah, money's not circulating right now. People are not. The bottom line is the velocity of money is important. I mean, with homes, real estate, investments, they always say, when I was a stockbroker, they just say follow the money. The institutional money, and you got institutions that renting homes right now, but the velocity of money is really kind of, there's a lot of velocity is coming from California to here, and that's where you're seeing. That's definitely a direct impact why you're seeing prices increase, because people are coming in from California and buying homes. But other than that, people are not going out to eat. They're not going to restaurants. They're not going to bars. I mean, they're not spending money right now. So there's another subset of the economy. I was talking to another loan officer, and I said, him and I were talking. He said, and I might have said this on the last time, but if I repeat myself, but he's like, he said, I said, where are these people coming from? He goes, you got to think about it. The people that are buying homes are the ones that are in IT. They can work from home. They're engineers. They can work from home. They're not they're not the ones that are working, hourly, say at a fast food restaurant. They're not being, these people are not being affected by it because they're still working from home. So there is that subset of the economy that's still buying homes. But like I said, economically,
we've got a question just came in. I'm going to jump in here real quick. It's from PJF, and he says, "Hi guys, what is the market like for multifamily properties?" And so the short answer is they're kind of in the same situation that single family housing is. There's an inventory shortage, but there's a real nervousness in multifamily housing, and it all depends on what Congress and Senate can work out right now. It's a very nerve-wracking, if landlords aren't protected by rental relief, you could see a flooding of not only multifamily hitting the market, but 23% of our homes in Arizona are owned by investors that are using them for long-term rentals. That could change really quick. So right now we're not seeing anybody flooding the market with them. So there is a shortage right now because of just the overall, state of the economy and COVID, but that could change. So that's a number to watch closely. I think if there's any changes in real estate, it'll probably start there first. It'll start with condos, townhomes, and multifamily first. If there's no rental relief that's real, and by real, I mean more than just Congress saying, you can't kick anybody out. Well, you're going to have to help them. So, you can still sell the whole building if you want to, and let somebody else take it over and say, by the way, 5 of my tenants haven't paid me in 6 months. You can still sell the building, just part of the math. So it's going to be a market to watch.
It's going to be interesting to watch the commercial market too. I mean, that's
commercial market's already in trouble.
Yeah. I mean, you look at shopping malls and it's just,
it was in trouble before COVID.
Yeah. Yeah. Like I said, the single family residents, I think that's, there's been a lot of, like I said, with rates being where they're at. I mean, even if rates go up a little bit, there's always this, when rates hit a bottom, people get used to it. They get comfortable with it. They get comfortable with, they call somebody up and what's your 30-year rate? Oh, I'm at 2 3/4 or 2 7/8. But then if rates do spike up, and rates have been very, very comfortable the last 2 months since really, really the last, let me see here. It has been the last, give me 1 second here. Since March 30th, really the beginning of April 1st, rates have gone down, 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 down. Every month they've hit a new record low. And so since April 1st, so April, May, June, July, and going into August, rates have been, there has not been much of a blip, like a sharp increase where they go from, say, 2 3/4 up to 3 3/4. We've had these instances in the last several years where rates were at, say, 3.5. They stayed there. The typical history was that I saw was that rates would stay, if they stayed low, they only typically stayed real low from a week to a couple of weeks, and then they spiked upwards. So we're in this period of time right now where the last 3 months rates have been very steady. We might get a shock eventually here where they go from, high 2s, low 3s up to high 3s. If they do jump a point, then there's always a pause that people get excited. I'm not going to buy. The rates have already jumped, but then they put in perspective and say, okay, my payment's only going up $60 or $70. Yeah, it's going up, but I can still afford this home. So there's always that initial shock when rates go up, and then rates can go up quickly. They go up a lot quicker than they do go down. So they've been very, very steady.
Well, I just checked on
a shock eventually.
I just checked on multiple dwellings for Arizona, and we only have 224 that are on the MLS. And of that 224, I'd say 3/4 of them are pretty crappy. They're pretty bad.
Pretty beaten up. Yeah, sometimes these multifamily, are in, they swear together in war zones.
Yeah. There's a couple nice ones out in Scottsdale for like 900,000. but there, other than that, there's not a lot to choose from out there. But I agree with you. When rates go, they go, and it's a shock to everybody because they can go up a half a point in one day and then a quarter of a point the next day, and it just makes everybody sit back on their heels. And and that may be if we even at this rate where this week we had 224 homes, more homes hit the market than actually sold for the week. If that trend continues for 3 months, we can get back up to normal inventory levels by Christmas. So it's just the little moves like that that can turn into big moves. And that's why I like to look at it every week, because we've been going 300 to 400 below every week, 300 to 400 below. But then the past 2 weeks, oops, we're up 200 units.
Mm-hmm. Yeah.
And then we have a guy named Arif, excuse me if I pronounce it wrong. He says, "Hi guys, people like me sitting on the sideline to buy a dream house. For us, is there light at the end of the tunnel?" Yes, I believe it's going to be towards the end of the year. And what I mean by light at the end of the tunnel is you're not going to see lower prices, but we're going to see some relief in the bidding wars to where you don't have to go out and compete with a handful of other offers at the same time, and rates will still be good. So try to do a little calculator and say, okay, we're going up at a 9% annual rate right now. So if 6 months from now, that house is 4.5% higher than it was when I started looking in July, yet I don't have to get into a bidding war, that might be a better plan. Because right now, if you look at a house for 400,000, or like what Pat said, what was that house? 390,000. They sold it for 4.25.
Mm-hmm.
The list price means nothing right now. So
they waived the selling agent said you're going to have to waive the appraisal because it's not going to appraise.
Yeah. So, but 6 months from now, if we normalize, the price you're looking at is the offer price. You're probably not going to see somebody offer 5% more. So it'll just be easier for you. I know now if you're waiting to buy that dream home, there's people out there that are waiting to buy it too, and you guys are going to have to slug it out, and you're going to end up overpaying in a lot of different areas. And the worst dangerous thing is waiving inspections. I don't recommend that no matter what the market is. So, because you can get in and go, oh, what's that drip up there?
Yeah. But people have to realize too that you can't get all, you're not going to be able to get everything that you want, because if buyer demand does decrease, but you say interest rates go up, right? Let's say they go from 3 to 4, and buyer demand does decrease. Yeah, you're going to see less demand. So there's kind of a damned if you do, damned if you don't, because you might see lower demand, but you're going to obviously your interest rates. So people like the gentleman said, he might find his dream house, but then rates might be a little higher. So he's going to have to realize that maybe some of the back off in the market is because rates went up a point, to back to 4% versus God forbid 4% versus say 2 3/4, 2 7/8. So, as I told you earlier in the onset, these rates coming down have allowed people to buy about $25,000 to $50,000 more in house.
Yeah, and then the other comment that we got here too is he says I think it'll be hard for locals to compete with out of state and institutional money. I think the out of state thing, it's anybody's guess how long that'll last, because if it softens in another state, you can't relocate. If you can't sell your house, you're not coming to Arizona. And the institutional investors, they're not finding any bargains out there, so they've really backed off. If we look at the large institutional buyers like Zillow, OfferPad, and Open Door, they were at 6.5% of our total market, and now they're less than 1% because they haven't been able to buy anything for the past 3 months.
Yeah,
they're getting outbid by Mary and Joe, the neighbor, and so they have nothing to sell. And so what happens when that happens is that investors that are investing in Open Door and Zillow, the hedge fund money, they're going to find someplace else to put that money. So I think that the institutional buyers only tend to sweep in when they see distress.
Oh yeah,
they don't see distress in Arizona. They're going to go to another state that's got distress, like Pennsylvania is looking like it's getting kind of tough.
Yeah, I mean, institutions swept in 2000, and I saw this. I saw this with my. I saw BlackRock, BlackRock Trust. BlackRock stepped in and bought tens of thousands of homes here in 2010. Actually, 2011 or 2010, 11, and 12 is when the big institutional money came in, and they bought these homes. I'm making up, just as I'm making up this, but they bought a house in Maricopa for $80,000 that's now worth $380,000. The institutional money came in when I was talking to the average guy, say, hey, this is a great time to buy. And they're like, no, I'm not, I wouldn't touch real estate with a 10-foot pole. That's when actually the institutional money was buying.
Yeah, they don't show up when the market's balanced.
No,
they show up. No. They show up when sellers.
Showing it in great. If it's low or really high, maybe that's one thing to keep on is, if you see, I kind of keep my eye out to see if there's any institutional money dumping. But they're renting these homes. They bought them. They're probably selling some stuff here and there. But they're renting a lot of them out, from what I understand, based on my last my past readings. So they're not dumping either because it's a strong market. So they're going to hang in there. So, but the institutional
imagine the amount of equity they've got.
Is not buying right now. I mean,
the ones that bought in 12 are sitting pretty sweet right now. They don't want to admit it yet, but they can afford to lower their rent dramatically and still be just fine.
Oh yeah, totally.
So, well, Pat, I know you got an appointment and you got to go, and so I'm gonna let you go. And to our millions and millions of listeners out there, we're going to free up some bandwidth on the internet now, because we know that it always chokes the system whenever we log on.
Yeah.
And I haven't got anything from YouTube yet, but I'm expecting an email soon. So.
All right, buddy. Have a good weekend.
Have a good one. See ya.
We'll talk to you soon.